On the agenda tonight, while top billionaire investors and insiders are dumping their stocks, the poor buys. What's going on?
There's no wealth created. There's a tremendous amount of wealth transferred. And I think you will see, when we look back on this era, you will see this as a period of enormous amounts of wealth transfer.
As monkeypox spreads, is it time to buy the dip in AMC?
Where we come from, apes talk. Humans are dumb.
And after more than 3 years in office, the most fake presidential candidate in history, Kamala Harris, finally reveals her economic plan.
Well, you're probably wondering if I have a plan. But of course I have a plan. A P-L-A-N plan. But maybe a plan is not what I really need. What I really need is just a little puppy. A little puppy with big brown eyes will just come to me and lick my face and just love me so much, no matter what kind of person I am.
All right. Today is Sunday, the 18th of August. This is a recap for the stock market activities for the week that was and an outlook for the week to come. And folks, I got a good one for you tonight. And shall we say, what a difference a week makes. All of the fear all of a sudden gone. Now, whether that's legitimate or not, we'll talk about that in a minute, but look at the flip-flopping that took place all of a sudden. Just a week ago, when we got the Japanese yen scare, and the stock market opened flushing down with a massive explosion in the VIX, aka the volatility index, the crybabies came out calling for an emergency rate cut. Oh, the Fed gotta save us now because the market went down, God forbid. You got crybaby, the good professor from Warren, Jeremy Siegel, who said that the Federal Reserve should make an emergency cut of 75 basis points and then commit to another 75 basis points in the month of September. Absolute insanity. Now, after a rebound in the stock market, oh, forget about it, there's no emergency anymore. Jeremy Siegel backs off on a call for the Fed to do an emergency interest rate cut. Oh, wow. That's the economist, right? This is the head of the Warren School of Economics. You got Goldman Sachs. Last week, because of the scare, Goldman Sachs upgraded the recession odds to 25% from 15%. Here comes the market rebound, which, by the way, a lot of technicals, a lot of mechanics behind it. And Goldman Sachs says, never mind, we're now downgrading the recession odds from 25% to 20%. The moral of the story is, number one, they have no clue what they're doing. Number two, Goldman Sachs will only let you know that the recession has a better odd of 50% after the recession is already underway, after you've already lost your job, and you missed on the opportunity of buying homes finally at a cheaper price because you didn't plan for it. Goldman Sachs will come out and say, hey folks, by the way, the recession odds are now greater than 50%. Oh wow. But folks, before we begin, let's talk about this monkeypox problem because folks brought it up last week. Oh, are we going to have shutdowns now? Are we going to issue more stimulus because of the monkeypox thingy? I would say maybe if the political polls change, yeah, maybe we'll shut it down. But right now, I don't think it's a concern at all. If anything, maybe if we get a spread of the monkeypox, it will cause a squeeze in AMC. That's the only conclusion that I got right now for you. But folks, to understand what's going on with the markets and the economy, we begin per usual by the Wall of Hope. And a reminder, the elements in the Wall of Hope, not rate cuts anymore, but actually no rate cuts. We've proven that last week, and this week we got even more evidence that if you do the rate cuts right now, you're pretty much announcing the beginning of the recession and the beginning of the crash. The market actually doesn't want any rate cuts right now because the market wants to have the illusion that the economy is still fine. And right off the gate this week. Now, it was not a surprise to anybody that we've seen inflation data receding. Even though we've seen rebounds, we talked about this throughout the week. If you look at the CPI report, for example, certain categories came back up, such as shelter, electricity, and transportation. But we have certain categories like used cars. Those are plummeting, the prices of used cars going down, and it's pushing the CPI down with it. This is not a surprise to anybody that used cars prices are going down because we have weakness in the economy. So getting a tame CPI was not surprising, but it was a requirement for another piece of data which was more important this week. And this piece of data was retail sales. Now, we've gotten many warnings from numerous companies that reported earnings this season, pointing out that the consumer is getting weaker. We're seeing lower demand, lower traffic. So the assumption and the fear by the market was if we get a weaker than expected retail sales data. Now, in the past, we used to push the market higher when we get weaker than average or weaker than expectations retail sales data. That was back when the market was embracing the mantra of bad news equals good news because it gets us closer to the Federal Reserve cutting rates. Now that we're there, the market, of course, it's a crybaby. Anybody with experience knows that. Now that the rate cuts are becoming closer to reality, the market doesn't want it anymore. Hence, we are in the mantra of good news equals good news. If we get hotter than expectations retail sales data, the market will love it because good economic news equals good market news. Well, guess what we got this week? The headline reads, consumer spending jumped in July as retail sales were up 1%, much better than expected. Now, the expectations were a rise of 0.3%. We got a rise of 1%, a huge beat against expectations. Of course, there are two ways to look at it. One way is, okay, they cooked the data to give the market some relief because there is absolutely no way that retail sales actually went higher when the corporations who are doing the retail sales say that consumer spending is weakening. The other way to think about it is, what will Jerome Powell and the Federal Reserve do about this data? Because on one hand, we're anticipating rate cuts in September, but retail sales coming out this strong, doesn't that push the rate cuts further down the line? And will the market still like that dynamic? Or will the crybaby come back and say, oh, but I don't want you to take the rate cuts off the table entirely. I still want to have my cake and eat it too. I don't want the rate cuts right now, but I want the option of having the rate cuts if I need them. Hence, the importance of Jackson Hole. But the take is, when we talked about this in the previous video, retail sales data for the month of June came out flat. That's the number that the cooks of the government gave us. And then a month later, they revised the number down. It was actually a decline of 0.2%. So for all you know, this number is a fugazi, and the cooks will come out next month and say, oh, did we say a rise of 1%? Whoops, we meant a decline of 1%. But for now, the market got its fix. That's what we needed for the market to go higher. And we gave this to the viewers since the week began, the strategy map. CPI. If it comes out hot, that wouldn't be good for the market because we have stagflation confirmation and the Fed will not be able to cut. Remember, the market wants its cake and eat it too. Doesn't want the cuts right now, but wants the option of rate cuts. Likewise, if inflation comes out too weak, too cold, then it's a confirmation of a recession. Why would we see a drop in inflation suddenly like this if the economy is still intact? So the best outcome for the market was in line, slightly weaker, that's okay. And we got that exactly. Now, the most important piece of data for the week, retail sales. And we told the viewers, if it comes out hot, that'll be actually bullish for the stock market. If it comes out cold, it'll be bearish. So it came out hot, and therefore we've seen positive reaction in the stock market. And you can see the saves here. This is the chart of the SPX, the hourly chart of the cash index of the S&P 500. Once you look at the MACD indicator and look at the chart closely here, you see a correlation. And you've seen throughout this rebound since the scare of the Japanese yen about a week ago, if we expand the MACD indicator, it was about to reverse about 3 times. When you see the green impressions in the histogram changing into red, that's how you know that the positive wave is changing into negative wave. Of course, when the white line, the MACD indicator, crosses below the average, which is the blue line. Last week, we were about to have one, but then we got the jobless claims coming out better than expectations. That was the rescue, so we got a move higher again, extending the positive wave. We're about to run out of gas this week and cross back to negative. We see an end of this rebound, but then came the rescue from the inflation data. But the rebound is so weak and running out of gas. A lot of folks are not believing in this rebound, so it curls its way back again, about to cross the negative territory. Then comes the fugazi retail sales rescue, and we move higher again. But folks, we're running out of gas either way. We've exhausted a lot of good news right now. And the risk becomes, what happens if we have a piece of data that negates the dynamic that we got this week, which is low inflation, but hotter consumer? The answer is we don't have a lot of macro data coming out next week that could challenge this narrative. And we don't have any corporate earnings that could come out from the retail sales. I mean, we have some like TJ Maxx, but nothing major that could challenge this narrative. We only have the cabal of central banks meeting in Jackson Hole. We'll talk about that. They could spoil the party if they say certain things. But besides that, we now have the path open after the market got an important confirmation of low inflation and stronger consumer. So we have plays that are open right now in the stock market that we can use at least until a piece of evidence comes out negating this dynamic of, low inflation, stronger consumer, no emergency rate cuts, no panic, no recession, and by the way, the option of rate cuts is still on the table if we want it. The dynamic is pretty positive. So we'll show you some plays that we've done and plays that we can do to exploit this dynamic. But bear in mind that the data will keep coming. Maybe not next week, but it will keep coming because this is the reality of the economy. For example, on Friday, we got the construction numbers. And listen to this headline. New home construction plunges to the lowest level since May 2020. So we do have recession news. And I think that the employment data, not coming out next week, by the way, but it will come out for the month of August. Once we head into September. In September, usually an ugly month for the stock market. And I think that the employment data will play a role in bringing out an ugly September because if the employment data show up weaker, not stronger, but weaker, such as we're losing jobs, or the market is going to panic again. Because remember, we're now in good news equals good news, bad news equals bad news. And the evidence that the retail sales data this week was fake. If it was true, the Federal Reserve zombies would have came out and said, you know what, maybe the economy is doing a little better than we expected. And maybe we can hold off on these rate cuts in the month of September. Maybe we're not going to do 50 as folks suggested. Maybe we'll stick to 25, if not even move it further down the line to October or beyond that, because retail sales data is strong. The economy is doing pretty good. The consumer is doing pretty good. But they know it's fake. And it's only done to prop up the stock market for now. And this is why I take, for example, Zombie Goolsby from Chicago, who came out and said he's growing more concerned about employment. And he warned that once the unemployment rate begins to move higher, it can get out of hand pretty fast. And this is what he's worried about. The acceleration of the unemployment rate happens really, really fast. And we said that we see the acceleration of the unemployment rate after the recession has already begun. There are a lot of indicators right now that the recession has already begun. Of course, Goldman Sachs will let you know after the fact. When the unemployment rate rises to 5-6%, then they'll let you know that, we got recession odds of more than 50%. Because Goldman Sachs is placing their recession odds based on the market action, not the data, not the facts. But the bottom line for now, folks, we go back to the wall of hope. Did we activate one element, shall we say reactivate one important element in the wall of hope, which is no rate cuts? Yes, we did. And that's a net positive. Now, when we look at the AI mania, is that intact? Yes, it is to a certain degree, but we're seeing signs of weakness, such as the China regulations, such as the top investors dumping these stocks and warning about them, the recent corrections in some of these names, exceeding double digits. So we have weakening, but the narrative is still intact. Now, of course, the biggest test for the AI mania will come when NVIDIA reports earnings. I believe that will be on the 28th of this month. Now, let's segue to the wall of worry. Of course, the two most important elements that caused a lot of the fear that we got were the geopolitics and what's going on with the Bank of Japan and the yen. Some of those concerns receded this week. So when it comes to the geopolitical front, no major action by Iran yet. Of course, we keep anticipating over and over and over again, and the longer we anticipate and nothing happens, the retaliation loses its value, which again could be a strategy that the retaliation would happen as a surprise. So investors are still aware of that. And you see positioning in the defense contractors, you see positioning in oil, but oil went down on Friday because a lot of folks said, okay, do I need to buy oil again on Friday? And then nothing happened over the weekend. And that was a sign that the geopolitical fears are just receding a bit right now, losing a bit of dynamic in the wall of worry, while we see elements in the wall of hope gaining momentum. And that's the shift that we've seen, and this is why we see a rebound in the stock market continuing. But once these dynamics change, the rebound will change too. As to the Japanese yen, we're looking at the JPY Japanese yen versus dollar, and I gave you my bearish versus bullish confirmation. If we're trading below, then that's bullish for the stock market. Trading above, that's when the margin call risk increases. This week, we dived further below this line. and the trend remains negative for now. So as an element of the wall of worry, the Bank of Japan Japanese yen lost a little bit of ground. If it comes back up again, then it's going to become a source of concern, and if the elements in the wall of worry overwhelming the elements of the wall of hope, then the dynamics in the market will change. But we do have some elements in the wall of worry that gained a little bit of momentum this week. Let's begin with the election risk. So now we know that Kamala Harris leading at the polls, and the headlines say that, the stock market went higher because Kamala Harris is taking the lead in the poll. Funny they didn't say that when the market went down, that it went down because of Kamala Harris. But the media also says that Kamala Harris' presidential prospects lift consumer sentiment. Everything is now getting better because, oh my God, we have the savior. Somebody we never heard of before, but now, we're realizing that she's the savior of the country. I say that sarcastically, of course, because she's been vice president for over 3 years now. But I want to address something here because a lot of you took offense when I said, hey, the Republicans are actually losing. Kamala Harris is winning. I do believe the polls. And folks said, oh my God, are you that naive, Maverick? All of these polls are fake. Okay, if one of them comes out as an anomaly, got it. But when most of them are pointing out to that result, then I think there is truth behind it. And when you look at how the Republicans are running the campaign, one of the worst run campaigns in history right now, it should be really easy because Kamala Harris is the weakest candidate. A cockroach can beat Kamala Harris in November and become the next president of the United States. But the Republicans are not even trying. Maybe by intentions, because who the hell wants to be president when the economy is heading into a recession? Do you want to assume that responsibility? I say I'm cheering for Kamala Harris to become the next president because I want the Democrats and Kamala to assume the responsibility of what they've done in the last 3-4 years. In any case, we finally got the economic plan by the Kamala campaign. And the reception is not that good, even from the media, by the way. We got the Washington Post, aka the CIA Post, and they say the Times demands serious economic ideas. Harris supplies gimmicks. Wow, that's the Washington Post, by the way. That's not me saying it. Here's another liberal publication, The Atlantic. And they say Harris's plan is economically dumb, but politically smart. What are they talking about? They're talking about the fact that her plan is pretty much political red meat, and that's about it. There's nothing of value really in the economic plan. There is no plan. They're just gimmicks and red meat to the voters. For example, inflation is a problem. She's been in office while inflation became a problem. Solution? Create a villain, and the villain is the grocery store, the corporations. We're going to crack down on them. No more price gouging. That's the reason behind inflation, and we're going to fix it if you vote for me. Well, you're already in office right now. Can you do anything about the price gouging? And by the way, price gouging is not why we have inflation. If anything, if we look at corporate earnings, you look at any consumer staple company, their margins are actually down. They're losing money year on year. Maybe they're not doing enough price gouging, and they can't do enough price gouging because the consumer is getting weaker. So this is baloney. This is bullshit. No facts, no data, no evidence supports the fact that inflation is due to price gouging by companies selling you food at the grocery store. If anything, if you want to talk about price gouging, you know where that's happening? That's happening at the insurance companies. They just feel like raising prices higher, and what are you going to do about it? You're not going to pay for insurance? Of course you're going to pay for insurance. But Kamala Harris is not going to talk about that because the insurance companies are the top donors to political campaigns. What else in the Kamala economic plan? Here's the headline: Harris to propose up to $25,000 in down payment support for first-time home buyers. Sounds good, right? Oh my God, another free cash, $25,000 for me to buy a home? Great. Here's the catch, though. The home should be no valued more than $300,000, which means what are you going to buy? A van? A trailer? Somebody's garage that Kamala's going to help you to buy? Maybe a couch? So this is a gimmick. It doesn't really work in reality. And if you're going to give folks $25,000 for a down payment, guess what's going to happen to the price of homes? They're going to go higher again by $50,000. So the $25,000 will not do anything really to help you out. But folks, again, when it comes to politics, it's a game. It's a vicious game, and either you know how to play it and you exploit the donkey voters, or you lose. Doesn't matter if you have the best policies or the worst policies, or you're fake or you're not fake, and you gotta give it to the Democrats. They know how to play this game, and they know how to play it way better than the Republicans. I mean, look at this ad by Kamala Harris. Look at the audacity of this ad. Take a look.
A home is more than simply a house. A home represents financial security. The opportunity to build wealth that can help put your child through college, afford retirement. That's what all this represents. When we lower costs for working people, when working people can buy a home, when working people can thrive, our nation thrives.
FFPAC is responsible for the content of this ad.
Wait a minute here. You're going to give us affordable housing now? Oh my God, how generous of you. Who's been in office in the last 3 years while we've gotten the worst home affordability in the history of this nation? All right. You really think that we are that stupid? And the answer is yes, we are that stupid. And that's why they're putting an ad like this. But then you look at the facts and the price increases since Kamala took office. Gasoline up 35%, electricity 28%, groceries 21%, wages 17%, so you're lagging all of these important essentials. Home prices up 16%, used cars up 14%, apparel 10%, medical care 8%. And these are the cooked numbers, of course. In reality, it's even more than that. But even with the cooked numbers, it looks bad for Kamala. I mean, how hard is it for the Republicans to rebuttal this? I can do the ads for you for free. Instead, they're talking about, radical liberal Kamala Harris. What? Who gives a shit? Radical liberal. Okay, we know that already. And for some voters, that's actually a good thing. The dumbest lines of attacks happening by the Republicans right now. It's so easy because they're dumbfounded. They planned all of these attacks against Joey B. The donors made a coup. They took Joey B out and they pushed Kamala in. And now they're confused. They have no lines. They have no preparation of how to take down Kamala. Well, it's really easy. Just show the facts. When Kamala says she wants to give us the home affordability, well, home affordability went down to the lowest level since 2007 under who? All you got to do is just show the chart. In 21, before Kamala took office, we had good affordability. Once she took office, the worst affordability in the history of the nation. Record low. Here's another chart you can use from the Atlanta Fed. Lower ratings mean less affordability. In 21, when she took office, we had good affordability. Then it sank to lows. Here's another one from the Atlanta Fed. The threshold for affordability should be no more than 30% of your income spent on housing. Well, gee, go back to 21, we had good affordability even in metro regions of the country. Here comes Kamala Harris, and we see the worst affordability. Now it takes about 44% of your income to afford a home in this country. Now, in reality, folks, is inflation really the fault of the Democrats or the Republicans or Biden or Trump or any of that? The answer is no. Inflation has always been a monetary phenomenon, as Dr. Friedman taught us. It's the Federal Reserve's fault. But when you play politics, you gotta be vicious. You gotta take the shot. And so far, the Republicans are not even trying. There was a moment in the recent rally by Donald Trump when he mentioned that. Just a moment. The rest of the rally was his routine, stand-up comedy, nothing more. But there was a moment when he hit it. And if they do more of that, the Republicans will take the lead. Take a look.
Yesterday, Kamala laid out her so-called economic plan. She says she's going to lower the cost of food and housing starting on day one. But day one for Kamala was 3.5 years ago. So why didn't she do it then?
Now, does the market really give a shit whether a Republican or a Democrat will take office? Not really. The market knows that both parties will serve the stock market at the end of the day. But what the market doesn't like is uncertainty, because it starts to plan ahead of time on the policies. So if we know that Kamala is ahead and she's going to win, the market will start making some moves and some preparation ahead of time. If all of a sudden Kamala loses the lead and Trump takes over, now we have to scramble all of these plans, causing volatility, and prepare for new plans. That's what the market doesn't like, the volatility, the uncertainty of who's going to win. Right now, we got some certainty, at least according to the polls. But as these plans begin to roll in, we'll think about them. So, for example, one positive to the market by the Kamala campaign, we talked about this on Twitter, is the fact that she's going to remove Lena Khan, which is good for the big companies, the Googles, the Amazons, because they're not going to be broken down. It's also good for the venture capitalists who want to dump a lot of shitty companies and exit in the market. It's good for Goldman Sachs, good for Morgan Stanley, the companies that would ride the IPOs and the dumping operations. But at the same time, if she's going to crack down on housing or she's going to raise corporate taxes, that's a negative that the market has to price in. Now we go back to the wall of worry. And there is another important element that could flare up this week. You see that Jerome Powell with the no deal thing? And that means no rate cuts. Well, wait a minute, isn't that a positive? Yes, it is. But as I said, the market is a baby. The market doesn't want the rate cuts right now because that's a confirmation for a recession. But the market wants the option of having the rate cuts if it feels that it needs it right now at some point. We know that we have Jackson Hole coming. Jay Powell can upset the market in one of two ways. Number one, if he says, you know what, I looked at the data, the recent employment data, I looked at the retail sales, really strong number. I don't see a reason why we should be cutting rates in September. the market is going to throw a fit. That's just psychology. We've seen it before, even though the market doesn't want the rate cuts right now. But if you take it away as an option, that's a negative. The other way Jay Powell can upset the market if he promises more rate cuts, aggressiveness in rate cuts. Then the market will speculate why. Why are you going with 50 in September? Why are you promising more rate cuts? We thought the economy is fine. So it is a balancing act for Jackson Hole, and he just needs to come out with the same ambiguity. We're going to be data dependent. If this happens, we'll do this. If that happens, we'll do that, and just keep it wide open. And if he does that, then we don't have a lot of obstacles to look for this week. Unless, of course, the geopolitics flare up or something happens in the Japanese yen and rallies again, then we got a problem. So how do we deal with the market right now? We segue from the macro discussion to the market discussion. And here's the map that I gave you last week. CPI in line, retail sales hot, that's bullish for the market. But bullish for who, really? Because the market is unequal right now. If it is bullish for something, it is negative for the other. Which names have been leading the rebound so far? It's the bigger names, the index type of names, the Apples, the Nvidias of the world. Some would argue safety, because if there's something bad in the economy, recession in the economy, for example, well, you got Apple with a lot of cash, you got Nvidia with the AI momentum still going on. Well, now if we have a confirmation, it's a fake confirmation, but we're just going to roll with it for now, of lower CPI, hotter retail sales data, then shouldn't that be good for other sectors that have been lagging in this rebound, that have been getting crushed because we have assumed that we have a recession coming and we hammered these equities, these securities? Okay, if the money rotates toward these assets, where is it going to come from? If you said dumping the big caps and what led the rebound so far, you got it right. You look at the SPX, this is the cash index for the S&P 500, a weekly chart. Good rebound so far, retracing about 75% of the drop. But then look at the MACD indicator, the momentum indicator. Are we out of the woods yet? The answer is no. And if we stall here and there is any reversal from this point, it's going to be dreadful for the market. Wait till you see the charts analysis. So stick around here, folks. But right now, looking at the MACD indicator, out of the woods yet? Not really. And if we take money out of the Apples and Nvidias, then the SPX will stall. Look at the NDX, the NASDAQ, more of an illustration to the technology cohort. It is lagging a little bit, the S&P 500, so here we have a 50% retracement, and the S&P we got 75. But look at the weekly MACD again. Out of the woods? Not really. Any stall here in a reversal will be actually a confirmation of the top and a confirmation that we're heading down big. Wait till you see the charts analysis again. But if I'm going to bet on anything right now, if you say, Maverick, we got lower CPI, we got good consumer data, we got to play something here. You got, 20 grand or something to play with. Which one are you going to buy? SPX, NDX? My hunch is no. Those are already rebounded higher. I want to look at the other stuff that got hammered because of recession data that should be moving higher now because of no recession data. Look, for example, at the RSP, the equal weight S&P 500. This is a weekly chart. Does it look like we're doing some consolidation here, gathering of energy, only to release that energy higher? Not overbought, still in the momentum indicators, not in the RSI, and the MACD here looks a lot better, that it's ready to move higher, crossing to bullish/positive territory. So if I had to choose, I'd go with the RSP over the SPX, the equal weight over the index, because I think the market will go back into a rotational mode again. And that's going to be the risk-on rotation and the risk-off rotation alike. So the dividend-paying stocks and perhaps the risk-on component like the smaller caps, the profitless companies, a lot of them did a lot better outperforming the market once we got retail sales data this week. But look at even the risk-off rotation, something like a dividend-paying stock like Coca-Cola. This is an hourly chart. Since the problem began, let's go back about a month ago. Believe it or not, Coca-Cola up about 10.5%, but then you have in pink, I guess, that's the Qs, the NASDAQ, down about 5%. So you got old school Coca-Cola, dividend paying safety, outperforming the NASDAQ. Okay, let's go back a little more. Let's go back, let's say March of this year, or about 5 months ago. Believe it or not, folks, Coca-Cola is still outperforming the NASDAQ, up 15, almost 16%, while the NASDAQ is up about 6.5%. Do we think that something changed right now as to drop Coca-Cola down when you have lower inflation and you have allegedly a stronger consumer? I think the money continues to go with the winner, Coca-Cola, and we take away some of the rebound plays in the NASDAQ. We see this dynamic. Coke going higher, the NASDAQ cutting some of the rebound gains. Another component of the rotation that got hammered pretty bad once we got recession fears, that's the IWM. So everybody said, oh, the IWM small caps is going to pop by 50% or whatever, because now we have soft landing. But then we got recession fears and the IWM went kaput. Now with the data that we got, we have a revival in the IWM. And Friday's session, the IWM small caps actually outperformed the NASDAQ, the S&P, and the Dow Jones. And I think if there was anything that's going to outperform this week, if this dynamic continues, it'll be the IWM, not the NASDAQ or the S&P. But not all small or mid caps are created alike. Since the rotation initially began, I told you that my favorite would be the IWS, that's the mid cap value index, over the IWN, which is the small caps value, and over, of course, the IWM, the Russell 2000, which is the small caps, including profitless companies, including a lot of risk-on segments. Let's go back to the month of August. Since the Japanese yen problem began. Sure, all of them are down, but the IWS down about 1.25% versus the IWN and the IWM, the smaller caps, down about a little over 5% apiece. So again, if anything is going to outperform from here, think about the stuff that we hammered because of recession fears, such as the cyclical stocks, which by the way, in the Maverick portfolio, we've added at least 3 names. Cyclical names that are hammered, beaten, bruised. We added these names to the longs, even if it is for a rental, just until we get another piece of data that throws cold water on this narrative that we have low inflation and strong consumer. Because if you have low inflation and strong consumer, then show me the money. Show me the hotels, the casinos, the airlines, the cruises going higher. Because they should. If you have an economy with no harm, no worries at all. I think the laggards, like the smaller caps, the mid caps, that took a hit from recession fears should be outperforming right now. But if you don't want to speculate, if you want to have, let's say, a soft landing play that not too speculative, not too volatile, and been outperforming, think about the J&K, junk bonds. Doesn't make sense, right? If we're heading into a recession, then junk bonds should be down big. But when the rotation initially began, we've added J&K to the portfolio as a dash to trash play. And believe it or not, J&K junk bonds actually outperforming the IWM since the whole Japanese yen crisis began. Not to mention, of course, it pays 6% dividend. I don't know if I'm going to hold it enough to capture the dividend, but holding it until we get a piece of evidence that says, nope, recession fears are actually for real. And we will get that at some point. But this play been doing pretty good so far. Again, outperforming a lot of the stuff that went down because of recession fears. Another play you can do is gold, and we've been saying that gold doesn't give a shit. Inflation, stagflation, dickflation, recession, doesn't matter. Gold will do pretty good. Dollar goes up, dollar goes down, doesn't matter. Because right now, with economic uncertainty and no legitimate dip so far in gold, we will see capitulation of folks who are waiting on the sidelines wanting to buy gold at a better price. Not getting it, they're going to have to capitulate and move in. And that's going to cause a breakout in gold. The fundamentals are still intact too. The headline reads, gold is getting harder to find as miners struggle to excavate more. And this is according to the Gold Council. If that was not good enough for you, we know that central banks, Chinese banks, a lot of other central banks in the world have been adding to their gold positioning. But even the hedge funds, by the way. The hedge funds been buying gold for a while now, preparing for something bad to happen. And all in all, folks, you look at the S&P 500, the relative price versus gold. And the market been flat versus gold for years now. So it makes sense that gold will outperform in this period, regardless of what happened, really. So if you don't want to speculate and you don't want to be subject to the data change week after week, I think gold is one of the best holdings right now. But folks, you got to bear in mind, when you see the big guys, the sophisticated investors, the top billionaires in this business, and you see their portfolio changes, they're dumping a lot of momentum stocks, they're dumping a lot of the larger stocks, the index-weighted kind of stocks, and they're buying stuff that is in the dumpster right now. They're just scrapping some value. Something bad is happening here, and they see it coming. And this is why they're taking profits from the stuff that went higher. And if they have to buy, they're buying things that went down, battered, bruised, already crashed. And this week, we got news that George Soros dumped $73 million in Alphabet and Amazon before the July nosedive. They know exactly what's coming here, folks. Not to mention, of course, that George Soros exited his entire NVIDIA stake. Sell it all, baby. Gone. You think you know more than Soros? You know, folks who are buying NVIDIA right now because they think it's an opportunity. You think you know more than him? You think you know more than the CEO, Jensen Huang, who's been dumping hundreds of millions of dollars worth of stock right now? Top investors such as Druckenmiller, Tepper, all of them selling NVIDIA, dumping the big cap technology stocks in, out, hello, goodbye, mission accomplished, unloaded to the dummies. Even Elliott Capital, Paul Singer, says the Magnificent Seven stocks are in a bubble. The headline here reads, buys this under-the-radar tech stock, which is, spoiler alert, it's Pinterest. But again, he's picking something that already got hammered, bruised, crushed, and finding value there. And the same thing, by the way, we looked over this during the week. You got investor snake Bill Ackman cutting Google, the top holding, cutting cyclical names like Chipotle, like Burger King, Canadian Pacific, Hilton. What did he buy? He bought Brookfield Asset Management, and he bought Nike, which already crashed. So again, they're finding value in stuff that went down big. You saw what happened with Starbucks, by the way. It's easy to manipulate stocks that already crashed because you have a lot of shorts, and the shorts have to cover at some point and book their profits. And you can move these stocks higher as an activist investor, as somebody who just opening a position right now by throwing in any good news. In the case of Starbucks, we got Chipotle CEO switching from Chipotle to Starbucks. That was enough to initiate massive short covering. Maybe Snake Bill Ackman will do another trick up his sleeve and cause short covering in Nike as the shorts close their profits and maybe rotate to shorting other stuff that went higher and now about to come down. The same thing goes for Buffett, by the way. Buffett dumping Apple, dumping Liberty, Capital One, cyclical for the economy, Chevron, Floor & Decor, another cyclical name. By the way, dumped Snowflake, which we didn't add here, but he got rid of Snowflake and he bought Ulta Beauty, a stock that already crashed, finding value in that stock. So they're still buying, but there's something that they see down the horizon that says the best of the gains already behind us, and we're about to see a downturn. While the retail investors say, no, the best of the gains are coming because of the Federal Reserve cutting rates. Folks, it comes down to this. What you're looking at right now is the 2-year yield versus the 10-year yield. If we're moving higher, the 2-year is outperforming the 10-year. The implications are that the Federal Reserve is hiking rates and we see the yield curve inverting as we see the 2 outperforming the 10. If we're heading down, it means that the Federal Reserve is cutting rates and we're moving from inversion to steepening again. Where do you think we're heading here? Just look at this chart, monthly chart. Where do you think we're heading at this point? Up or down in this ratio? Maybe you're not sure. Let me help you out here. We're going to plug in the momentum indicators. Look at the RSI, look at the MACD. Where do you think we're heading? If you said down, check out the big brains on bread. Now we go back to the chart and we plug in the S&P 500 in, red here. And look at what happened every time we see the 2 versus 10 moving down. We see a market crash. If you said that the 2 versus 10 is heading down, then what are you saying about the stock market? It's heading down too. But I know what you're going to say. You're going to say, but look at the divergence that we got right now, Maverick. The S&P is going higher and the 2 versus 10 is going down. Maybe this time it is different. Let's go back to 07, 08. And again, you see that the S&P 500 moved higher while the 2 versus 10 was going down for a little bit. And then came the crash. This always happens. And the big guys see it ahead of time. And they know that the party's over. In a nutshell, here it is again. We see a steepening of the yield curve and of inversion every single time we got a recession in the economy. Every single time. And this time, it ain't gonna be different. Another piece of evidence that we got to that is the MOVE index. This is a weekly chart. This is for bond volatility. So we've seen the volatility in equities, the VIX exploding higher during the Japanese yen crisis, which is not over, by the way. But we haven't seen bond volatility. That's about to come. And when you see bond volatility, the game is over. Now, before we segue to the market information, let's talk about classic mistakes that took place during this rebound, what happened before. The crash of the yen and the rebound that followed thereafter. But during the rebound specifically, because it is a classic trap, and we talked about a trap within a trap during last week's video. The 3 classic mistakes that happen during such a rebound. The bearish mistake is betting on a reversal of the rebound before it happens. And the next thing you know, the rebound keeps going and going and going and going. And now you're holding a position that continues to lose. The bullish mistake would be exiting a rebound play early out of fear that a reversal is coming. And guess what? Yours truly, the guy you're listening to right now, fell into this one right here. So everybody's prone to do these mistakes, but at least I didn't lose money as the first circumstance. This circumstance is just you left some money on the table. For example, we got a play on Apple, the 220 calls, expiration date August 16th, which was last Friday. Exited that a little too early. And I told you guys, look, this is what I'm doing right now. If you want to keep it, keep it. I hope some of you kept it because it was a really good trade had you kept it all the way till expiration. We had another one for Amazon, the 170 calendar calls. I closed this too early. Again, if the trade was kept all the way till expiration, it would have produced gains excess of $6 100%. So again, we're all prone to do these mistakes. Amazon closing at 177 at the end of the week. And the last mistake, and those folks still haven't paid yet. So the first mistake, they paid dearly. If you bet on a reversal and the rebound kept going, you paid dearly. If you exited a rebound play too early, you paid for it, of course, by missing out on a lot of the gains. Now, the last mistake is being too greedy by not booking profits from a rebound bet. Meaning you say, you know what, it's been going pretty good right now. Maybe I'm late to the rebound, but I think we're going back to the moon, baby. And next thing you know, they pull the rug from underneath you. For whatever reason, fill in the blank reason. And now your profits are gone kaput. You're going to pay for it. Go to the outro of last weekend's video. I showed you the scene from The Color of Money. Great movie, by the way. The charisma of Paul Newman's character in that movie, worth watching alone. But I played the scene when he says you need brains and you need balls to win. And he got more of one but not the other. The mistake of betting on a reversal and a rebound before it happens was too much balls, too little brains. The mistake of exiting rebound plays early out of fear of a reversal was too much brains, overthinking, but too little balls. The third mistake, too much balls, too little brain. It's a balancing act. You need both. So how do we avoid doing these mistakes again? You stick to the moving averages and the indicators. Of course, there was a trap that happened about Wednesday, not this week, but the week before, where we got a rejection of the 100. And a lot of folks might have gotten sucked in by saying, okay, the rebound is over. Down we go again. But there was no confirmation after that. We've actually crossed above the 100. That was the moment when the first mistake could have avoided. Hey, why are we above the 100 days moving average all of a sudden? We have a reversal off the reversal. I'm going to take my reversal bets off the table right now until we lose the 100. Now, avoiding the second mistake of taking the rebound plays a little too early. Did we lose the 100? No. So we can play with the rebound all the way till we hit the next moving average, the 50 in blue. Okay, we hit the 50. Any reversal, any rejection right now? Not really. Okay, we're above the 50 now. Discipline says you book the profits at this point. So without a rejection or a reversal already, it was worth keeping those rebounds plays. The third mistake, how do you avoid it? You look at the moving averages again. The nearest one is the 50. If you lose the 50, then we got a reversal. It's over. The rebound is over. And we got a reversal off a lower high, by the way, which is a major problem. We'll talk about that in the charts analysis in a minute. But this is how you avoid it. Just look at the moving averages as a parameter. There's nothing magical about the moving averages, but it makes it visually easier for us to make decisions. And this is how we use them. Anyhow, folks, let's add more color to this conversation by looking at the market data. We begin with the closing of the indices last Friday. And here we go. The diamonds in the green by 96.70 points, or a gain of 0.24%. The Nasdaq also positive by 37.22 points, or a gain of 0.21%. The Spider also positive by 11.03 points, or a gain of 0.20%. And the Russell 2000, the outperformer of the day, up by 0.56 points, or a gain of 0.26%. Now, you gotta understand that the problem with the Russell 2000 is there are a lot of folks who bet on it ahead of time, only to see it going down, and now it left a bad taste in their mouth, as if, okay, I'm not going to trust it right now. So I think that's the reason behind the hesitancy. But according to the macro data, fake or not fake, the IWM, the Russell 2000, should be outperforming from this point on. Looking at the sectors on Friday, financials at number 1, number 2, communication services, number 3, cyclicals, and then we see the defensive sectors. I mean, industrials had its own problem because of waiting, but healthcare, real estate, defensives, not doing badly, but coming at the bottom of the pack as we now rotate back into risk on. Looking at the weekly performances, technology at number 1, the Apples, the Nvidias of the world. The laggards, the defensives, the risk off, utilities, real estate, defensives, comm services were down because of Google and then Meta on Friday. But I think the dynamic next week should be changing where technology begins to take the back seat a bit. We see more of the risk-on segments like the cyclicals, some of the industrials and the metals beginning to move higher and take the lead. Looking at the breadth on Friday, improving a little bit, but within the neutral line, the NYSE 59% advancing versus 39% declining. NASDAQ 55% advancing versus 42% declining. And again, the 52-week highs versus lows. The lows are still taking the lead over the highs, but the gap is closing up. So that's a net positive to the market. Looking at the daily heat map on Friday, all over the place, but we're beginning to see some of that rotation happening. For example, in the healthcare segments, coming out of the Eli Lilly, the NVOs, and going back to biotech and buying the laggards. We've seen a lot of the technology gains in the chips, for example. Some of them went red, such as AVGO, Qualcomm, Microsoft, Meta. That's, of course, on the heels of the earnings from AMAT. But we see other lagging sectors for the week, such as financials, gaining some steam. Some of the defensive plays were also lagging as the big caps took the lead, defensive meaning dividend-paying names, such as the Verizons, the AT&Ts of the world. Those came back Friday while we see some of the momentum plays receding. Within industrials, it's the same thing. Momentum is ETN, Eaton, and the building names. Those are down on Friday, but we see the laggers like UPS, like Deere, like Boeing catching a bit. You see it somewhat in energy too, where the name of safety in energy was Exxon. The others were beat. Now that we see a permission for risk on, as we get lower inflation and a stronger than expected consumer, again cooked or no cooked, we see some of the lagging names in energy beginning to catch a bit. Likewise, the cyclicals, again, we see some activities going on there in restaurants, in the stores, beginning to catch some momentum. Looking at the contrast for the week, pretty much everything did pretty good because it began with the big caps and the chip names leading the rebound. Then as retail sales data came out, we've seen buying of the laggards, the cyclicals, the industrials, the financials, and all in all, it was a positive week for the market. But now as we head into a new week, we have to comb through this map. Which ones are we going to stay with? Which ones are we going to rotate out of? And I think what we're going to rotate out of would be the stuff that went way too high in the rebound, the Nvidias, the Apples, the Amazons of the world, and rotate into the names that just began to show some momentum later during the week. Looking at the weekly heat map for the ETFs, TLT up, meaning the bonds went higher, but bond yields went down. But the dynamic throughout the week was more important. So once we got retail sales data, yields actually popped, and the TLT bonds went down. I think the majority of the gains that you see in the map right now were printed Wednesday into Thursday. Then comes Friday, we see yields coming back down and bonds catching a bit the TLT. And that feedback didn't register yet. And if it does register as, oh, we're going back to recession fears again, forget about it. The map will change dramatically. We haven't also seen what happens if, say, Jay Powell says retail sales data too strong, I'm not going to cut rates right now. We see TLT actually going down and the yields spiking higher. That would also be a net negative to the market all in all. So the sweet spot for the market right now is no volatility in bonds. If we see a lot of volatility because of auctions or because of Fed commentary, we know we don't have data this week, but that's going to come in the week after and then in September too. And we're going to see bond volatility, no doubt about it. But the sweet spot right now, little volatility in bonds. But again, the question becomes, even if that happens, we have to comb through the map and decide where we're going to stick with and where we're going to rotate out of, meaning taking profits. I think the answer is clear. Moving on to commodities, what do we see here on Friday's session? We have a drop in oil before the weekend, which is quite unusual because of the geopolitical fears. We usually buy oil into Friday because who knows what's going to happen over the weekend. But now we see a red day instead. Could be because of OPEX, but it could be also due to frustration by the traders that we've been buying the protection over the weekend, buying oil, and nothing happens. Then we see mostly positive activities in softs, in cocoa, coffee, sugar remains. Some of the top performing commodities, softs that is. Then we have metals, gold up by about 2%, silver joining gold for a change, but gold outperforming silver for the week. We talked about this last weekend. You want to stick with gold, not silver right now. Silver is tradable, but not investable as much as gold. Mixed action in grains and in meats. Meats mostly down, grains mostly down, but then we see soybean oil finally finding a footing here, but not quite enough to play a serious rebound bet. If we look at the weekly performances all in all, OJ at number 1, coffee, silver, palladium, copper, all among the outperformers. The laggards, soybeans, soybean oil, canola, cocoa, and the gasoline RBOB right before the elections. Of course, it makes sense. Now, we talked about sugar as the trade of the week, maybe. I didn't do that, though. I did copper instead, because the dollar was weaker throughout the week and looked that it's going to weaken even more. And so far, so good. Copper was actually up about 4% for the week. And I think if the dollar continues to weaken, we'll see more gains for copper. Sugar futures are looking pretty good, but they need a little more before we jump in. Moving on to the big casino options, what do we see here on Friday? OPEX, so the volume should be higher. But believe it or not, the volume is actually down. My hunch is a lot of retail investors who are gambling in the options market lost a lot of money before the drop. And now they need a little more before they hop in. They need to see even more gains in the market before they hop in. But some names saw a surge in contracts like Nvidia and Tesla, of course. We see more calls now overwhelming the puts. We used to see puts in the 40s, now in the high 30s. So the fear is not completely washed out here. The good news is, suppose you're a trader who holds a bearish view and you think that the rebound will be limited and then down we go again and you want to shorten the video or you wanted to shorten the video or take a bearish trade on it or any of the names that you see right here. The good news is the IV ranks are now way suppressed. We used to talk about 100% of the IV rank in NVIDIA, 90s in Tesla and Apple and other names. Well, now we're down to 50s. I mean, look at Amazon, about 10%. There's pretty much no existing volatility in Amazon. And the VIX got crushed all the way to the 14th, 13th, meaning that the puts are way too cheap right now. The question is, are you going to enter them? My hunch is you're too scared because you think that the rebound will take us all the way back to all-time highs. But if we indeed reverse and we start trading down, and the volatility increases, and these prices become more expensive as we see the IV ranks coming back up, you look back at these IV ranks right here as a missed opportunity. Am I suggesting you have to shop for puts right now? No, but I'm saying that if you begin to see signs of reversals, I gave you indicators last week, I gave you the moving averages, I'll give you the charts in a minute. If you see those signs, you should not hesitate because the key to success in options is to buy cheap, sell expensive, not the other way around. Looking at the buy flows, bullish versus bearish, they bought calls on Carvana, TLT, Meta, Nvidia, AVGO, Coin, Apple. They bought puts on Intel, your girlfriend, the ticker GF. No, I'm joking. That's actually feeder cattle, I believe. They bought puts on Pfizer, Airbnb, VIX, but most of the put buys are insignificant, just smaller amounts. So Intel's the only one that's notable. And then when we look at the sell bullish versus bearish flow, they're closing puts on Intel, but we just talked about they're buying puts on Intel, so what's going on here? Maybe they're closing the winner puts, booking profits, and they're rolling down, which is not a positive sign for Intel. Then they're also closing puts on Disney, Airbnb. Looking at the bearish flow for the sell side, they're closing calls on Amazon, on Apple, on Carvana, on Coinbase, on Nvidia, a lot on Nvidia, over $150 million worth. So you have to look at these flows, the expiration dates, and make a judgment to it. We can't waste a lot of time here showing you these flows by individual names and expiration dates, but you got to utilize this tool and see where they're buying puts, where they're closing puts, where they're buying calls, where they're closing calls with the expiration dates. That's going to give you a clear impression where the flow's betting on, really. Looking at the unusual activities, what do we see here for LQD buying the 113, 115 call spread and spending about $3 million on those for the expiration date October 18th. So this is a bullish bet on corporate bonds. Then we have a long call for BNO. This is for Brent Oil, buying the 32 calls, the expiration date October 18th, and spending about $2 million. This is interesting because we're betting on oil going higher. Then we got the ticker team. One of the beaten down software names. Somebody is finding an opportunity here and buying the dip. They bought the 175 calls, the expiration date December 20, spending about $1.6 million. Here we're going to play for coal, BTU, for Peabody. They bought the 27 calls for the expiration date October 10th, spending about $300,000. So they're betting bullish on coal, on uranium. We've seen those before. They bet on Brent oil to go higher. So I think it is a bet against the dollar here. Then we have the puts. We begin with FND, Floor and Decor. Big Buffett, of course, dumping the stock. It is a cyclical stock. We see bad housing data, so somebody's betting for more pain to come. They bought the 90 puts for the expiration date October 18th, spending a little over $650,000. Here we have another one against the EEM. This is the Emerging Market ETF. Kind of weird because if the dollar is going down, then EEM should be doing better, but somebody bought the 42 puts for the expiration date November 15th, spending about $2 million. And here's the last one that we got for you, a bearish trade against MSTR MicroStrategy, which is a proxy bet against Bitcoin. Somebody bought the 133 puts, the expiration date September 20, spending about $1.2 million. We'll look at the chart of Bitcoin in a minute. But before we do that, we begin with the SPY, the S&P 500 hourly chart. What do we see here? We go back to the MACD indicator. Rescue after rescue after rescue. We have the save here with the hockey stick symbol. But now we're running out of gas. At some point, this momentum has to normalize. Now, it doesn't mean that we have to flush down and end the rebound right away, but it could be a point of consolidation. And if, by the way, if we resolve the bearish momentum in the MACD indicator via consolidation and no major damage done, it would actually be a bullish indicator that higher we go in the rebound. But right now, the risk versus reward, when you see the RSI way overbought in the hourly, when you see the MACD showing signs of running out of gas and reversing from bullish to bearish, you gotta respect that at least if you've been playing the rebound, it is time to book some profits and begin thinking about what happens when this rebound frizzles out. Because right now, if we stop here, we could be stuck in a range. And you see the range right here, let's call it 555 and 510. We could be stuck in this range and being a subject of the data and subject of the Fed's commentary. And we move up and down based on that. I'm in the camp that we're going to take the lows in time, but before we do that, we need to get a sign of a reversal. And we can look at that in the daily chart. We're above all of the moving averages, but we're stopping at around 555. So that's a resistance line before, and it's going to stay a resistance for now. If we do a reversal from this point on, and we take the 50, that'd be a warning signal that, hey, watch out here, but not enough to say that we're going to flush down. If we lose the 100, then the risk of a flush down and a lower low becomes highly likely. So it's a step-by-step process right now. You need to see a loss of the 50, then a loss of the 100. You need to see a crossing above 555 to assume that we're going back to the highs or closing the gap if you happen to be in the bullish side. And by the way, if we plug in the Bollinger Bands, that would be in or around the upper Bollinger Bands. If we look at the weekly chart though, here's where we can find the problems. Let's retrace the journey of the wave. Which wave we're talking about? We're talking about the weekly wave in the MACD indicator. Go back to the fourth quarter of 22. We've seen a higher low in the MACD. Okay, signs that maybe we're bottoming, at least for now. Followed by an improvement in the MACD indicator, and then a crossing above the zero line, not just the MACD, but also the average, the blue line. That's a confirmation of the bullish wave in the MACD. And the bullish wave goes on. But at some point, the wave has corrections too. So we've seen the first correction during last summer in 23, and it was scary enough that it could be a reversal. But we got to save exactly at the zero line when Jay Powell came out and said, you know what, we're maybe going to do the rate cuts. And then we've seen a rebound and a continuation of the bullish wave in the MACD. Came another correction. It didn't end the wave though. We went back right at it. Now we have another correction in the wave. The question is this it? Is this the one that takes us down below the zero line, ending the bullish wave once and for all? Too early to say that. But if we see a stall right now in the tape, or we begin to reverse down, then the risk of this is it becomes highly likely, because this could be a reversal of an ABC pattern. And if that happens, if we stall here, understand that we got the top for sure, we're probably going to end the bullish wave phase. And that usually comes with sharp corrections to the downside. We're talking about not just the regular 5 to 10. We're talking about 15, 20 to 30. So it is imperative for the market right now to hold these gains and not reverse right away. Another way we can look at it, if we plug in the Fibonacci retracement levels, if we fail here, forming the inverse ABC will be down below 500. The next support we got is 482.25. Again, important not to fail here. For some of you who trade the SPX instead, again, we have 555 from the SPY, so it is 5,555 from the SPX. If that is a point of rejection, then we're stalling at the shoulder line from the topping head and shoulder pattern. And that will be a problem because if we go to the SPX, the weekly chart, again, if we stall here, it could be a reversal of an inverse ABC, and that would lead us all the way down to the equivalent of the SPY's target that we just gave you, being around 4,953.36. On to the Qs. What do we have in the hourly chart? Same thing as we've seen with SPY. We have a save after save after save. But now it appears that we finally lost the momentum in the hourly chart. Again, it doesn't mean that you have to flush down. You could resolve those via consolidation. If you see that that is the case, it is actually pointing out that the Qs is going higher. Just keep that in mind. If we play out the end of the bullish wave in the MACD in a steeper flush down, say we lose 469, for example, then okay, we have to retrace some of the support lines, close some of the gaps that we opened on the way higher. And we could be stuck for a while between the range of 475.55 as resistance and then 423.45, the low from the end crash, as the support. Would be subject to the data, subject to the Fed commentary. But you have to look at the daily chart, folks, to have any confirmations. So we know that the Qs is lagging the SPY, which is comfortably above all of the moving averages. But the Qs here is going back and forth with the 50 days moving average in blue. If we have a failure, it is okay so far, but it is a warning sign that if you've been playing the rebound, you gotta at least book some profits. If we lose the 100, then we got a major problem. And the 100 is all the way down to 457.19. Stalling here has significance because if we plug in our indicators and support resistance lines, we got a topping head and shoulder. And right now, we're stalling pretty much not at the shoulder line as we've seen in this SPY, but we're stalling at the neckline. So failure here is significant. Because if you look at the NDX, the weekly chart, we study the wave again. This is really important for you to follow. We've seen corrections before, but these corrections did not end the wave. How do we know for sure that we're out of the woods in these two examples? Back in the fourth quarter of 23 and in the second quarter of 24, we got corrections, but they did not end the weekly bullish wave in the MACD. Well, we've made higher highs. In the first example, the previous high was 15,932.28, and we got out of the woods. In the second example, the high was 18,464.70. Once we traded above, when we closed above, we knew that we're out of the woods. This one, we're not out of the woods. We're not trading above the highs yet. So you got to be careful not to be sucked in here too much, because any failure at this point without making the highs will mean that the top of this wave is in. And down we go in an inverse ABC pattern. And it might actually end the wave when we go back to a bearish wave. One step at a time. The IWM daily chart, what do we see here? Closing above the Fibonacci retracement at 211.23, and I think that the IWM, if there's any index that's going to move higher this week, and should move higher, it would be the IWM based on the macro data. The only problem for the IWM, of course, is the hesitancy by the traders, because they got a bad taste in their mouth. We got the flush down. Now they don't trust the IWM anymore. From a technical perspective, though, what is the next hurdle for the IWM? Clean up the chart, plug in the Bollinger Bands and the 20 days moving average in white. You can see that the 20 sitting at 213.25 right now is the next confirmation / obstacle for the IWM. Looking at the dollar, bear flag, but not playing out as to make lower lows. I think it's going to happen in time. We're stuck in a range right now, and the dollar, if it is saying anything at all, it is saying, watch out, I'm seeing weakness in the economy. Retail sales or no retail sales, I'm seeing a problem here. And that's why I'm going down. Now, the problem with the dollar going down is it also elevates the Japanese yen. If it elevates the Japanese yen too much, then we have to talk about the margin call risk again. What about the old man gold breaking out now above the triple top? Momentum looks good. And again, I think that if the dollar is heading down, then you got to stick with gold going higher here. And it's actually in the midst of a breakout. You look at the weekly chart for gold, it appears that we have a consolidation range, gathering of energy, and now the energy is being released to the upside. We talked about this last week. Sure, overbought, got it. But think about the psychology. If you've been waiting for a better price to enter gold, you're not going to get it. So a lot of capitulation right now, and that could cause the breakout in gold. Silver is okay too. It is showing bullish signs in the MACD. It closed above the 100 days moving average in red, but it is lagging gold, folks. So own gold, trade silver. The way I'm doing it is owning gold and then hedging via trading silver. The way we can look at SLV is if we use a line chart, clean it up a little bit. How about an inverse head and shoulder bottoming pattern? Looking at light crude, daily chart, not good action here on Friday's tape. We lost the 20 days moving average. The momentum indicators look weak. No confirmation yet, but they're looking weak. And I think right now this is why we got the traders dumping oil even more during Friday's session. Once we lost the 20, it was forget about it. We don't have an ABC breakout. We're actually failing here. So it is imperative that we see crude above the 20 moving average again to restore any hope and momentum of moving higher. Now, in the long run, looking at energy stocks, you look at the weekly chart for ExxonMobil. Right now, it looks as a bottoming inverse head and shoulder that's about to release the energy to the upside. Another way we can look at it is, how about a cup and handle pattern? So Exxon looks pretty good. Of course, Exxon is not going to outperform if we see a crash in crude. That's just logical. But if we see stability in crude, you don't even need the prices to go higher by much. Just stability. It looks to me that Exxon wants to go higher. High dividend paying, value, cheap valuation, lots of cash in hand, and this is why we see it as a resort to safety kind of play when we have risk off days in the market. Looking at the 10-year yield, what do we see here on the daily chart? Higher low for now, and it looks, looking at the MACD, that the momentum is about to shift to bullish, meaning we see higher yields. You gotta remember that the market looks at this as good news equals good news. But there is a threshold when too much of a good news becomes bad again. And that is the point when J. Powell and company think that the economy is still too hot and that doesn't merit the cuts in September. If we get to that point, then it becomes bad for the market too. Looking at some of the yield-sensitive ETFs, such as the XHB Home Builders, look, you can come up with the conclusion from the macro data of low inflation and a stronger consumer from retail sales data that it's a net positive for the XHB Home Builders. The problem is recession fears are not eliminated. And if we see bond yields going down big because of that, that's a net negative for the XHB. Likewise, if we see a hotter economy and mortgage rates coming back up, meaning yields coming back up, that's a net negative for the XHB too. So I don't think it is the best rebound/rotate trade right now. We have bad data from the housing market. It just keeps pouring in. So we stalled at the 20 days moving average right now. Not shortable until we lose the 100 days moving average though. And that's all the way down to 106.15. Looking at the IYR, it performs a little better, specifically if we have lower bond yields. And the reason is, we look at the safety of dividend plays, and we have some large components in the IYR that pays dividend. But if bond yields go higher, then the rotation comes out of these names. Maybe to play some of the risk-on segments such as the IWM or the regional banks, KRE. So look at this chart right here, stalling at the 20, but once we close above the 20, I think all of that energy is released to the upside in the KRE. If we have nothing that negates the data that we got from last week, which is lower inflation and better than expected consumer, allegedly. Of course, that's a good dynamic for the KRE because we see a move higher in bond yields, but not too high enough to upset KRE. And likewise, we're not going down in bond yields because of recession fears anymore. It's a good short-term play for now, and we have some plays in the KRE that we've done in Discord. You look at the VIX weekly chart, closing below the 20 days moving average, that's a negative, but we're not out of the woods yet. If we see another positive closing above the 20 weeks moving average, I think the VIX is just reloading and ready to go higher again. Looking at Apple, back at almost the top of the shoulder, green candle after green candle, no stop here. Peculiar to some, since Buffett, of course, dumped. But I bet that a lot of folks looked at it as safety when we had the Japanese yen crisis. That, okay, at least Apple has some cash here, so we're just going to put a blindfold on and buy Apple. Now that we have better macro data, I think the money should be coming out of Apple and rotating elsewhere. And of course, we can look at it as perhaps a rising wedge type of pattern. Looking at the souffle Tesla, this one was not moving higher with the rebound as much as Apple and Nvidia. So it is among the laggards that we could see rotations into. Looking at the MACD indicator, improving a little bit, it might turn bullish at some point. We closed above the 50 days moving average in blue. We have the 20 coming out next, but again, the 50 is more important. So long as we trade above the 50, we can play the 220, 230 calls as a starter and then see what happens. If we lose the 50 again, then it's a bad sign. But for now, I think the odds suggest that higher Tesla is coming than lower Tesla. So I think that the play right now, at least for me, is the 220, 230, unless we lose the 50 days moving average, which is right now sitting at about 213.63. Here's NVIDIA for you. Above all of the moving averages right now, even the 50. If we lose the 50, we got a problem. If you've been playing a rebound, you got to take your profits and move on. Because if we shift to the weekly chart, that's where we see problems. Remember the wave in the MACD that remains negative and it didn't change. If we stall here, we lose the 50 days moving average, then maybe we're forming an inverse ABC pattern, and that's going to be a confirmation that the top is already in and we're finishing the bullish wave. And we might even go down to a bearish wave, and that could take us all the way down to the lower Bollinger Bands. I don't think that's going to happen before the report is out, but you got to keep an eye on these leading indicators. And losing the 50, you got to at least book some profits. Not a permission to short yet until you lose more moving averages, such as the 100 days moving average. Zooming into the hourly chart, are we beginning to lose some momentum? Look at the MACD wave. Yes, we're running out of gas. It is too steep in a short amount of time. So we might have a retracement to 120, even 117. That's okay. But if you lose 117 by the end of the week, and you lose the 50 days moving average by the end of the week, so the 50 is 120 almost, 117 is the confirmation of the loss of the 50, then you know what's going on here, which is more downside for NVIDIA. Here's Bitcoin for you. Rejection of the 200 days moving average in yellow, but now we're playing with the 20 in white. You look at the wave in the MACD indicator, changing from bearish to bullish, but without any conviction. So we got to give it the benefit of the doubt. Confirmation for bullishness, if we clean up the chart here, is of course closing above the 200 days moving average. Then you got the all clear. Confirmation for bearishness is losing what we call the neckline in the topping and a shoulder pattern. That's in or around 56,500. Let's move on to the conclusion of this video. What do we have on the economic calendar this week? We got not a lot, but we got a lot of Fed zombies speaking here. We begin Monday with Christopher Waller, and then we have U.S. leading economic indicators. Tuesday, the 20th, we have Atlanta Fed zombie Bostic. comes the 21st Wednesday. We got the minutes from the last FOMC meeting. And then August 22nd Thursday, which is more important from a macro perspective than a zombie perspective because we got initial jobless claims. We got the flash PMIs on top of existing home sales. Comes Friday the 23rd, most important day of the week. The big zombie Powell comes from Jackson Hole. And then, of course, we have new home sales. My 2 cents, I think it'll be a good week for the rotational plays. And then we'll see what happens. Either Thursday, we get too strong of data from the PMIs or too weak, and that changes the perspective. Or Friday, Mr. Powell from Jackson Hole. Either he plays it right and stay ambiguous, or he makes a confirmation one way or the other and upsets the market again. With that, folks, if you enjoyed the show, found it informative, please return the favor by pressing the like button, subscribing, leaving a nice comment, and consider joining us as a member to access the daily videos in addition to bonus videos. But with that, folks, this is all I got for you for tonight. Thank you for listening, thank you for watching, and I will talk to you again tomorrow. Good night.
Quick buck artists come and go with every bull market, but the steady players make it through the bear markets.